All right, welcome everyone. Season 3, episode 6 here from What Are Your Thoughts? I appreciate everyone's patience in between the previous episode and this episode. I should say, did a cross-country move, and the wife got a really awesome promotion. So we picked up and moved across the country, and here we are in the greater St. Louis area. So thanks for the patience there. And obviously with the volatility that's going on in the market right now, things are very busy, just business-wise and new prospects, current clients, everything, right? We want to make sure that they're still on track. And even though we've had 3 straight years of high double-digit returns, of even this, 15% correction so far that we've seen in the market as of this recording, it makes people feel uneasy, and especially those people on the cusp of retirement. So really focusing back on how we frame returns and expectations for returns and for the clients in retirement, making sure that their income strategy is very sound, and reviewing the income strategies. And most importantly, or one of the most important things, is sequence or order of return risk, which I've talked to clients about, is just when you retire, the first few years of returns play a huge, if not the biggest factor in your retirement plan's success. So making sure that your plan is sound for really anything that comes your way, and just maintaining that focus on what you can control as the investor, because you can't control the day-to-day volatility in the market or what the market does. And it's tough, and it makes investors uneasy at times. So going back to having that plan and keeping that plan in place is really big for investors of all ages. And we're at an interesting point, because investors right now that are, 30 to 35 or right in that age range have only really seen the market go up. So we're just in a different time psychologically, is what I mean by different time. And it's important to just keep the planning mindset and keep the planning focus for your plan, and work with someone that you trust, right? And, there's a lot of different reasons why people hire an advisor, whether it's a one-time thing or a year-long subscription or full, long-term financial planning and investment management. There's a lot of different reasons, but one of those reasons is to help the psychology that is investing. So that said, sticking with the thought process of how you think about returns and framing returns. And I had a prospect that I talked to that was talking about maybe getting into some non-stock market based investments in order to get a higher return. And so I wanted to break that down of, what would it do to someone's plan to just be an average return investor, right? If we didn't necessarily look for those home runs and we focused on the things we could control, and what would it mean to be average in terms of investing? And I came across a video. I subscribed to some investment research services. Obviously, being an investment advisor, I want to learn from people that are very smart. And I came across a 2-minute video from a great mind in finance named Morgan Housel. And I've recommended, the Psychology of Money book before. And so anything, and he wrote that obviously, and anything that he talks about or posts or writes about, I'm always looking at, because I think I have a lot of similarities in terms of my thinking and just what it means, in this case, what it means to be just an average investor. So I'll play that clip here so you guys can listen to it.
When you understand the math behind compounding, you really realize that what works with the compounding, what makes compounding incredible, is just time. Compounding is returns to the power of time. The exponent is time. And the longer you can stick around, the better you're going to do. Really simple. So therefore, the question that I want to answer as an investor is not how can I earn the highest returns? Because that's not really what matters. The question I want to answer is, what are the best returns that I can sustain for the longest period of time? It's all about how long you can stick around doing it. And of course, the key to sticking around long enough is survival. By survival in the financial sense, I mean not getting scared out of the market, not going into debt that's going to force me out of the market, not making sure that I'm chasing the right goals and I'm not going to change my goals too much and like change my asset allocation too much. I just want to be like, what can I stick with and leave alone and just let marinate and compound for the longest period of time? And I think that's not intuitive in a world where it seems so obvious that what investors would want to do is earn the highest returns. That seems so obvious, but I just think it's more complex than that, because most of the time, the highest returns that you can earn this year are not the highest returns that you can sustain for a long period of time. Like maybe, there are a lot of investors who will do way better than me this year and next year over the next 5 years. But I'm pretty confident that if I can earn average returns for 50 years, anyone who can do that will be in the top 3%, 2% of investors over time. And it's a weird thing that by consistently doing average, you're going to end up way above average. That again is not very intuitive, but that's the power of survival. And even better, of course, is if you can be someone like Warren Buffett, who's earned incredible returns for a very long period of time. That's when the results just get ridiculous.
That's just such a great clip. It's one of my favorite clips really that I've seen maybe ever, but definitely this year. And I just wanted to highlight a few things, and it might make sense going back to listen to that multiple times, but there are a few takeaways from that specifically. And a lot of times when I meet new prospects, their thought or, they've just heard from different sources, whether it's online or elsewhere, just talking about highest returns. What can I do to earn the highest returns? What can I do to, beat the market and what have you? And the point here in this video that Morgan, I wouldn't say argues, but discusses is it's not a 1 year high return that matters. It's consistently good returns that you can sustain that matter. And the sustainability is the hardest thing. We've all, unfortunately, that's not what sells, right? It's not sexy to do that. And there's so many articles in the marketplace like, oh, here are the highest returning mutual funds of last year. And then people dump their money into those and it doesn't happen again. And it's just a chasing game at that point, and that's not what earns the longer term highest returns, right? It's like you mentioned in the video, of course people want to earn the highest returns, right? That's obvious. But what does it take to actually get those long term and make them sustainable? So that's the first point, and the biggest, or one of the biggest takeaways is just, it's not about home runs once, it's about base hits for the long term. And so that's really key. And also, I did a whole series on just how could you even put yourself in position to beat the market? And the sense there is that to put yourself in position to do that, a lot of times it takes some level of a concentrated portfolio rather than a diversified portfolio. And a concentrated portfolio can be either feast or famine. It can make a portfolio or it could break a portfolio. And so in a financial sense, when Morgan talks about, not getting scared out of the market, that's huge. Having that right perspective that I mentioned earlier is really key when developing a portfolio. On top of that, making sure that you have goals and you have the right goals on why you're investing the way you are. Right? I mentioned earlier that I had a prospect that was talking about doing some alternative investments other than the stock market, which is great, right? I'm not an advisor that pinholes like, oh, you have to have all your money invested or else it's not going to work. There's a lot of different ways to build wealth in this country. But that said, there has to be a why component to it. Why are you doing this, and what type of returns might you get for the opportunity cost that it takes to get them? Are you going to be stressed about them? Are they liquid enough for you? AKA, are you locking up your money into something that, might eventually pay you back, but you don't know? And there's pros and cons to every investment decision. So making sure that you are chasing the right goals is so important, and making sure that you have the most efficient investment portfolio. And when I say investment, it could be stocks and bonds, real estate, crypto, etc. When you chase those goals, making sure that you know the types of investments that you're in, and making sure that you are aware of, why you're doing those types of investments, and does it move the needle to get you to those goals that you have set, right? Because your portfolio is really only the tool that we are using to fund the plan to meet your goals. And you have to have the ability and, financial sense and intestinal fortitude, I guess you could say, to stick with that and not get scared out of the market, which feels so easy to do. And we know that the market being down this year, it feels riskier, but really that's the opposite of what is going on. If someone was to sell you a business, or try to sell you a business for, $1 million, but now you're able to pay $850,000 for that same business, would you buy that business? It's the reverse, right? As prices go down, risk, generally speaking, goes down in the market. So it's really key, right, to make sure that you are chasing the right goals, staying invested, and having that plan, right? It's easier to get scared out of the market if you don't have a plan, because then you don't really know why you're invested in the first place. All right. So the next little takeaway from that 2-minute clip is, I have the transcript here, and he says, because most of the time, the highest returns you earn this year are not the highest returns that you can sustain for a long period of time. So that's kind of what I was talking about a second ago, is just sustainability. And that's the key. And yes, we think in long terms when we're talking about rates of return in the market. And for clients that are saving money, that's great, right? You can think long term. But what about the clients that are retired or in retirement? We circle back to that plan. And I had someone that's on my monthly email list. And if I basically do 1 or 2 emails a month that just give my perspective on what's going on. If you want to sign up for that, send me an email, info@lifepointplanning.com. But that said, I had a prospect actually that we talked maybe a couple years ago, and he just likes to follow my content and isn't ready to quite make a switch yet, but emailed me just about, hey, I'm in my first few years of retirement. Is your advice to just stick to the plan? And so this person has some Social Security, they have an annuity, things like that. And really I took it from the approach of income, right? And when we're building out financial plans for people, especially those in retirement or on the cusp of retirement, they may not have the benefit of compounding for 30, 40, 50 years. So talking about income planning and making sure that their base needs are met first is really key. And then over and above that, talking about the sustainability of that income so that they can have some level of peace of mind knowing that the market day to day won't necessarily affect their basic needs in life. We can match some fixed income sources like Social Security, annuities, etc., to their fixed expenses, and then match their variable expenses to some type of variable income strategy. And I've said this before, but I'm a fan of building in rules when we are in the withdrawal phase of retirement. And what I mean by rules are like, if the market is down in any given year, maybe the next year's worth of income, we don't give the client a cost of living adjustment. We could do some type of ratcheting strategy where if the portfolio is up, we give the client a raise or we ratchet that income up. It's very, there's a lot more factors when the clients are in retirement versus when they're savings. So that said, though, focusing on an average return, the data says one thing, but in reality, we want to earn the highest return that you can sustain. And yes, maybe that is a high average return, but we want to make sure that as investors, we are sensible to the notion that there will be down years and that the past 3 years, right, 2021, 2020, 2019, don't happen all the time, and they can't happen all the time. To think that if, the markets were up 20% per year, I mean, that's just not a thing and something that investors should not get used to. So it's just key. And I know one of the quotes or one of the sentences that Morgan Housel mentioned in here was, he said, I'm pretty confident that if I can earn average returns for 50 years, anyone that can do that will be in the top 2-3% of investors of all time. That may be true. So let me break this down into 2 categories and continue on with my thoughts here. Investors that are young or younger, right, and have time, the best thing to think about is sustainability. How can I sustain sensible returns, right? We've all seen articles about people that double their portfolio in a month or, what have you. And that's just not realistic to sustain. You might do it once. That's awesome. But it's very, very hard to sustain. So those people that have time left and compound in their dollar cost averaging money into the market, a 15% decrease should be very attractive to them in the market because they can buy things on sale. Switching gears and continuing on with my thoughts about those investors that don't have 50 years. If you're just starting retirement, one thing that we can do is segment the portfolio and have, dollars for shorter terms, or we can do a bucketing strategy and have dollars that are allocated for the next few years, or keep a couple years of income in cash or short-term CDs, making sure that they earn something, and so that they don't have to withdraw assets in retirement in the first few years of retirement, should they be subject to a bad sequence or order of returns for their first few years of retirement. That said, though, we still want to put them in position to earn that average return, because a retirement could be 20, 30, 40 years long. So that time horizon is still not today, right? People don't retire and just cash in their portfolio and move it all to cash and say, all right, hopefully this lasts 20 years. There's other things, especially like right now, talking about inflation, that play a big factor in still earning a return for their portfolio. So the real question is, what are the best returns that an investor can sustain for the longest period of time? And I'll wrap up with that thought as I finish up the pod here. But I just wanted to say thanks again to everyone listening. I hope this content's super relevant. If you're able to leave a review on your podcast platform of choice, I know our biggest audience listens on Apple Podcasts. So if you're able to leave a review there, that's awesome. And also Spotify, you are able to leave a review there as well, and at least a star rating. So I appreciate everyone's thoughts and questions and everything that gets sent in. When I started this podcast, it was just for fun for me to learn about things and how to portray them to clients and prospects and everyone. So I appreciate all the great questions and the following that we've built, and I apologize again for the delay between episodes. Thanks so much, and we will catch everyone next time. Take care.